there's a major tax change ahead. IRC Section 199A, Qualified Business Income Deduction, is set to sunset and expire at the end of 2025. This deduction has been a massive break for owners of pass-through entities like sole proprietorships, partnerships, and S corporations. With this expiration on the horizon and no confirmed renewal, business owners need to understand what this could mean for their bottom line. Meanwhile, C corporations will still enjoy a 21% federal tax rate, which could flip the tax strategy game entirely and reshape it. What is IRS Section 199A? The QBI deduction allows eligible pass-through business owners to deduct up to 20% of their qualified business income for their taxable income. It was introduced under the 2017 Tax Cuts and Jobs Act, which was a way to create parity between pass-through and C corporations, but not all income qualifies. There are limits based on the type of business, the W-2 wages paid, and the capital investment. Essentially, my friends, it has been a powerful tool that has saved entrepreneurs thousands annually in taxes, and it has really reshaped the tax arena. Why is the QBI deduction sunsetting? The QBI deduction was always intended, my friends, to be a temporary deduction, sunsetting at the end of 2025 unless Congress extended it. It was a political compromise. C Corp cuts were made permanent, while pass-through relief was only given a time limit. Right now, there's talk in Congress about extending it, but nothing is guaranteed. Given the current political climate and the competing priorities, the QBI deduction may simply disappear. But what happens if QBI goes away? Without the QBI deduction, many pass-through business owners will face a sharp increase in their effective tax rate. Allow me to give you an example. Let's say a business owner is in the 37% tax bracket currently and only pays on 80% of their income without QBI. That full 37% applies. This change could increase their effective tax rate as much as 7 to 10 percentage points for some businesses. Meanwhile, C corporations still pay just 21%, making them significantly more attractive in certain cases. Not to mention, they are considering reducing the C Corp tax rate to 15%. The impact on pass-through entities can be tremendous. If QBI sunsets, sole proprietorships, partnerships, and S corporations could lose a key financial edge they have been doing for years. Their federal tax burden could become higher than that of C corporation. It also throws a wrench in long-term planning, especially for businesses that structure themselves as pass-throughs to capitalize on the QBI. Suddenly, pass-through status may no longer be as an efficient option. Why will C corporations might become more attractive? With their fixed 21% rate, C Corps could be the clear winner if QBI is not extended. This could lead to a rush of business owners converting their pass-throughs to C corporations. But it's not just about the tax rate. C Corps come with different rules on distribution, double taxation, and corporate governance. So while the lower rate is appealing, business owners really need to evaluate all the implications before making changes. Here's what you need to know as a business owner. You should do this now. Don't wait for Congress to act. Start assessing your current tax structure and potential future liabilities now. Meet with a tax advisor who understands the nuances of business taxation and entity structures. You may want to run side-by-side projections of your tax liability as a pass-through versus a C Corp. Also consider timing income and deduction strategically between now and 2025 while QBI is still in play. What is the legislative outlook? Is it hope or is it hype? There are lobbying efforts underway to extend or even make the QBI deduction permanent, but Congress is divided and tax reform is always a politically charged issue, especially during election years. Even if legislation is introduced, it may be watered down or delayed. Business owners, you need to prepare for the real possibility that QBI goes away, and you need a plan B ready. Be proactive, not reactive. The potential sunset of QBI is one of the biggest shifts that you can have as a small business owner. And this is not just a tax issue, it's a business strategy issue that could affect how you grow. By planning now, you can avoid being caught off guard if the deduction disappears. The smartest move you can make is today. Stay informed and stay ready. "21% federal tax rates could flip the tax strategy game entirely and reshape it.